Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. In my youth, there was a song, What a Difference a Day Makes. We'll get into that in a second. Market call, 1 o'clock on the East Coast. Guy Adami, Dan Nathan, soon to be, when I say soon to be joined by the great Carter Worth of Worth Charting. Dan, how are you? Your hair looks fantastic. Did you get a cut or something?
I did get a cut this morning. And he always asked me at the end of it, do you want me to style it a little bit? And I said, sure, I'm in the chair. Why not? So it's a little styled here, but we are good to go, Guy. Yesterday, interesting. What a difference a day makes. Yeah, man. I mean, like, listen, it's so funny. We're going to go over a lot of single stock charts after this. And some of them, not particularly impressive, although they're eye-popping, some of the gains that we're seeing. But, we'll see.
You know what I don't. So I think the on the tape, the market call, the OK Computer, the Fast Money audience, I would imagine they've gotten to know me relatively well over the last, with this 4 years, maybe a little longer. Fast Money approaching, 17 and a half years or so. Is that fair?
It is fair.
Okay. So, and I'm not saying I'm some tough guy, I'm not Dolph Lundgren but I like to think that I'm not, soft either. And when I mean soft, like,
yeah,
that kind of soft, like,
yeah.
Jeremy Siegel embarrassed himself. It was embarrassing. It was embarrassing what he did yesterday, and we actually addressed it last night.
So wait, just give the audience a little refresh.
Well, he was on the Squawk and Friends, I believe, in the morning, and he was calling for, 75-point emergency rate cut. And I'm watching this, and the man was like, he was a little exorcised, a bit apoplectic. I'm like, my goodness gracious. I mean, that's a little extreme. And then last night we addressed it on the show, and I said, "What exactly is the?" And I was being serious. Like, what is the emergency? It was the emergency that the stock market went down, because that is not an emergency. Stocks actually do go down, believe it or not. So today, with the S&P up 107 handles, and the Nasdaq up 2.25%. By that logic, is it today a day for an emergency rate hike? Because it's just dumb. So anyway, Jeremy, if you're watching, good luck this semester at the University of Pennsylvania. I'm sure your students will be engaged, but you embarrassed yourself yesterday. Back to you, Dan.
I like that. All right, let's.
It was embarrassing. It was embarrassing.
I know. Let's throw the rundown up here really quickly. Dead cat bounce for stocks? ? We're going to ask Carter about that in just a minute. You and I are going to update a crude oil trade, and we may turn this thing around, Guy. Who knows? We'll talk about that a little bit. And if we're talking about glittering, it is the shiny metal. You got some views there. We're going to talk about that, and then we'll probably come back to a little bit about what the Fed's prerogatives are right here. All right, let's bring him in. Carter Worth of Worth Charting. Carter,
what's up? Always, what do they say? This business keeps you on your toes, right?
Yes, it does. Yes, it does. And it's great to have you. By the way, you ran into Doug. If I say where he was, Dan, am I doxing him?
You're doxing him. Yeah.
So, but anyway, Carter,
you ran into him on the street, which is really cool.
I did. He had his granddaughter. We had a nice visit together there. In a brief moment, I had two of my kids, or maybe one, and my wife. And yes, all good.
All right.
So.
Cool.
We get through that. So we're going to look at charts. I'm going to throw this out, and I think Dan probably agrees with me. I think for market participants who are bullish, which is just about everybody, I think the best case scenario today would have been a flush to the downside, just a violent move lower, and then a subsequent sort of grind higher. What I'm looking at today, and we sort of tease this in the rundown, looks to me like a bounce off a very short-term oversold condition with that VIX spike yesterday. Now, maybe yesterday was it, and, I will once again look foolish. But again, if I'm just trying to sort of read the tea leaves, I would have much rather the market flushed early than do what it's doing right now. Thoughts on that?
Hard to know. Obviously, it so much depends on where you close, and the open is very important. We know the last half hour is important on both sides. But to be fair, right, an oversold condition, surely, however one wants to read it is at hand, was at hand. And the thing about extreme overbought and oversold moments is they always get more overbought or oversold. So, for instance, obviously the day before yesterday, we were already through the bottom of Bollinger Band. We were at fairly extreme RSI readings and so forth. And yet we, of course, came in and plunged even further on the open yesterday. As to the ricochet, we're about to fill the gap associated with yesterday's drop in gap, and so forth and so on. And just for the record, look, a lot of people don't like the gap work. You'll find that no major sell side firms focus on it. I've made it a part of my business, part of my career, because I believe in it, and it's a very nuanced subject. People think it's quackery, but it's not. It's a very real, and anyone wants to be in touch with me can tell you for several hours why the phenomenon exists. Either way, we are on the cusp of filling the drop-in gap from yesterday's open. But of course, there's another gap immediately above that. And it all gets down to, is it a dead cat bounce? Everything that falls bounces, and no one knows, does it carry through tomorrow? Does it stop right here? We go red today. But day-to-day, second-to-second momentum is important, and we clearly have some momentum. That's a nice formation. You see the intraday chart there, and my hunch is you let it run.
Yeah, Carter, let's pull up a chart we have of the S&P futures here, the E-minis, and that's the day chart, obviously. I just draw this line, and maybe it's arbitrary, maybe it's not. That was the breakout level from a few months ago. Might we find a little resistance here? And to your point, there's another gap up there. We know gaps like to be filled. So, one of the things that strikes me is that, from peak to trough, so July 16th to yesterday, which was August 5th, we had about the same amount of the sell-off that we had last year from July 18th. I think maybe the low was October 22nd. So, as we use that term dead cat bounce, I would say that you can say that when you have a precipitous drop, right? but not the sort of 2+ month drop that we had last year. So talk to us a little bit about how quickly we got down 10%. And what do you think the likelihood? What would you expect for a bounce where you might want to reshort it if you thought that some of the conditions that were in place for this sell-off are going to continue at some point later in the summer or maybe early in the fall?
Yeah, it's around 5,400. So there isn't much import to that red line, to be fair, right? That's support by broke. If we were, and we could probably do it here on the fly, if we were to simply put in the trend line that's in effect from the November 2023 low connecting the April-May low, you will see that, of course, we broke trend. And if you throw back to the underside of the trend that you broke, that becomes an inherently difficult level. In the cash, it's around 5420. But you can see with your eye, you draw lines with your eye. That is the idea. In order to draw one for real, you first see it in your eye. It's why I use the expression over and over, what my eye sees. So let's see it together. If you connect with your eye, the November low, and draw a trend line to the May low, that trend was broken with the swoosh of the preceding 2-3 days. And this ricochet, if and as it carries further, would take you back to the underside, to the penny of that line that we've just drawn with our eye.
Allow me to ask you a question, CBW. And we talked about this last night on Fast Money, but I have a bit more time here with you. So if Jacob can pull up a longer term chart and go back to 2022, and as difficult as 2023 was for me personally in terms of prognostications, and most of this year as well, 2022 actually made a lot of sense to me. And it was, sometimes you feel like you're standing in the pocket and you have all kinds of time. And that's what 2022 felt like. So here's what I'm going with. The year started out in December, and the market just started to sort of cascade lower into June. In June, in the middle of June, the VIX traded up to 34.5. This, again, after the market had sold off pretty consistently for a 6-month period. And you had this crescendo in the form of the VIX spike. And that proved to be a short-term low. And you saw the bounce. We actually outlined it. Then you saw a significant sell-off in October where you saw the same type of move in the VIX. And that proved to be a low. I mentioned that because what we saw yesterday was clearly a spike in the VIX, but it took place at the beginning of a move lower, not at the end of a 6-month move lower. Does that have any bearing whatsoever? In other words, what I'm trying to say is, as much as yesterday felt like capitulation vis-a-vis the VIX, can it be capitulation when we're effectively right around all-time highs?
Right. So it can be capitulatory in the sense it's been 14 sessions of selling and it's been straight down for this day-to-day phenomenon. But the notion that somehow it will be capitulation, that we've reached an important bottom for the market, that inherently is unlikely. The market's only down, 9-10% from its peak, 9.7 as of yesterday's low. I guess the both the severity and quickness and steepness of the drop is both it's what gets you the ricochet, right? If you just slink and slump lower, there's nothing to ricochet from. So it's the precipitous nature of and the crashing type element of the trading. VIX was literally the third highest reading since the financial crisis low and COVID. So it's the sort of the crash, the drop, the plunge lower that gives you the ricochet, and yet it's the fact that it did drop that precipitously that is the negative, right? You understand that if things are perfectly normal, you don't crash like that. This is a mini crash. To make that point, this is, and if we can go back even further on the VIX, let's pick up the financial crisis. So if we'll go to, let's see what we got here. Okay, not quite. You're gonna have to go a little bit more. Getting to get to about 08. And so now, if this populates, yeah, you just got it. One more. And well, let's get the current. Here we got the current. One more, and fair enough. Let's just stop there. So you see, well, we don't have the current spike, but anyway, you can see that's financial crisis. You're talking about, I mean, it's one thing to have a recession, it's one thing to have a lot of, the financial system was at risk, right? I mean, literally, you have banks collapsing, Federal Reserve, or you have Warren Buffett lending money to Goldman Sachs. I mean, this is it. So that's an epic spike, the most all time. And then you have the COVID spike, and then you see on the far right, on the axis there, sort of, but this is the third biggest one in a generation. And so really quick, and one could say, well, does that mean it's over? Many would make that case. The issue here, of course, is that damage has been done. There are people who haven't done any selling at all, who will just start to warm up to the fact that maybe there's more risk than I thought in being generally and entirely long equities, believing in whatever it is, AI forever, or innovation forever, productivity forever, America forever. No, nothing about America. The point is that there will be people who will start to cut back, having taken the hits that they've taken in their P&L.
Yeah, and Carter, we were talking about it last night on Fast Money. We were trying to figure out it. We want to, Melissa goes around the horn. It was essentially, why do you think we sold off the way we did over the last few days in such a violent manner? And each one of us, there was 5 of us on the desk. We all had kind of different answers, right? And so again, it was one of those things where I felt like people were looking for an opportunity to maybe take some profits, especially in some of the most crowded sort of stories. But again, on the flip side of that, Goldman had a report out, JP Morgan had a report out. The net buying that they saw yesterday during market hours was, far exceeding, any other day in the last year or so when there had been a sell-off. And so I think it was the violent nature of that. That's the only thing that the VIX tells me. The VIX is not a particularly good tool on a day-to-day basis. I know guys brought this up. It's a great tool when you have those extreme readings, you know what I mean, on a short-term basis, but most people don't even know what the VIX calculates, right, anymore. And then the other thing I'll just say is the systematic trading has just taken over. Like, that's something that's very clear to me. I mean, I think all of us would look at a down 14% opening in an NVIDIA with no specific news. It's not like they, reported, guided down and that sort of thing. So a lot of funky stuff, if you will. So again, who knows if it's a dead count bounce, but Carter, I want to go to yields here for a second. We kind of charted them yesterday a little bit. And you see the uptrend, going back to, last summer or so, that was just violated, right? You've been calling for that. We had that 5% move down to 385 last year. That was something that you really, kind of charted for us at the time. Here we are. We break that uptrend. It looks like a head and shoulders. We just had this discussion on the Fast Money call at 12:30, and I think, Guy, you brought up this question. Has the market already moved ahead of what the Fed might do, right? And so the 2-year looks a lot more precipitous. Maybe Jacob could bring that up. So thoughts here, if we finally get, let's say, a 25 or 50 basis point cut in September, assuming they don't do a surprise, has the 2-year moved in front of that? And I'm just curious. I'm not asking what you think about what's going to happen in yields. But let's just say the base case, and we'll put up the CME Fed Fund tracker in a second. Has it moved ahead of it is my question.
Is that me or Guy?
Yeah,
No,
that's for you. I'm
that's for
sorry.
you. I'm sorry.
Oh, well, so here too, it's just about the rate of change, right? It's that angle, it's that huge intraday reversal, it's the gap. As to whether the market, which is almost always the case, ahead of the facts, a stock that's slumping and everyone says it's great, and all of a sudden they miss their earnings. Price is almost always ahead of the facts. So presumptively, yes, the yield here has already taken care of, or doing to some extent the Fed's work for it, and the Fed will follow along behind the market like a dutiful child.
Like a dutiful child. I love that. And we had a really interesting conversation last night. And again, I mean, I don't want to get too in the weeds because we want to be somewhat actionable here, but people wishing for rate cuts here. And Carter, you said this a long time ago, and it's sort of stuck with me, and I agreed with you. You said there would be a place in time where lower rates would actually start to be a net negative for the market. And you started to see a snapshot of that over the last couple of weeks, and obviously you saw a huge snapshot of that yesterday. Now the question is, if in fact the Fed does cut rates, what does that signify? Will it be a panic thing, or they see something more, I guess, nefarious out there? And I think that's the rub. And I'll say this again, as much as yesterday, Dan, was about the yen unwind, and we have a question that we can address on the back of that. Remember, this started, if you go back and look, we've had some data, some really weak data around the economy that sort of crescendoed on Friday with that jobs report. And we had been talking about, again, the Somm rule with Elizabeth for quite some time. That has now been triggered. And as much as people want to say it's different this time, Dan, the reality is every time that's been triggered, it's been the precursor, again, of a pretty significant drawdown in the economy. And that's been my concern all along. I'm surprised it's taken this long.
Yeah, and you've been saying that about unemployment, and again, we don't have to get into what the Somm rule is again, but you've had this move from 3.6 to 4.5 or something in unemployment rate. And when I think about the economy, maybe Jacob can pull this up. The Atlanta Fed GDP now for Q3, they just ratcheted up from 2.5% to 2.9%. Okay, you know what? Maybe they're wrong all the time. Maybe they're not. But we're nearly halfway through Q3, right? And so if you think about that, I have to think that we're probably, a recession is a 2025 thing if it happens, but the market is a discounting mechanism. And so at some point it's going to start to kind of weigh, the chances of that. And maybe that's what happened a little bit Friday into Monday. All right, Carter, we really appreciate you. You did some heavy lifting with us yesterday. We appreciate you being here with us today. We'll see you very soon, bud.
Yep. Bye.
All right, Guy, you and I were going to update a couple things. We've been talking about crude. We've been moving down the stop, short of it in the futures here. Let's pull up a one-year chart, because these are the sorts of levels that you thought we could get down to. You and I talked about this yesterday, and I thought it was interesting, kind of the push and pull versus, let's say, weak growth, right? And the potential for some sort of geopolitical stuff to put some demand on crude here. So when you look at this chart, you see that 200-day moving average up there, 78.5 or something like that. We're kind of back. We broke the levels, I think, from June a little bit. And again, maybe this support level is a bit arbitrary, but thoughts here, because the last two times it touched this over the last year, we've seen nice bounces above 80. One was kind of the mid 80s here. So thoughts on
I think that's what you're going to see again. I think we're down towards support. Look, it's the old definition of insanity is doing the same thing over again, hoping for a different result. And I finally caught on to that the last time we talked about crude in a meaningful way, and that was on the back of a bounce. And I said, over the last couple of weeks, I said this will continue. I said, but I've learned the hard way. It's probably going to fail again here at the moving average, and that's exactly what happened. So finally, I sort of got something right. But however, now you're back at support levels, and nothing really has changed other than the slowdown here in the economy. But one has to think that a lot of that's been priced in. So the geopolitical risk, which still exists, is in and out of the crude trade. But you're at support here. So I look at this. We're down to basically the February lows. We're effectively where we traded down to in June. The times we've gotten down here, we've bounced. We have made a series of lower highs, which is obviously negative, but we'll see if we hold here. I think we will.
Yeah, and again, we were looking at this about a month or so ago. It was early July, and I think that breakdown of that little flag, that was the thing, below 80. We were, short of it at 82. We used an 84 stop. We have this move. I think it got as low as 72-ish, guys. So we had a little bounce over the last day or so, 73 and a quarter. We're looking at it now. So if you were like short of it at those levels, I'd be covering here. And, there was a good little trade. And one of the things that was really important as we updated this over the last few weeks is like we kept on moving that stop down, right? As we got into a decent sort of profit, we wanted to kind of make sure that we kept a portion of that profit. So now if we look at it at 73 and a quarter, Guy, I think the first level that we'd be focused on is that 200-day moving average. It is declining a little bit there, but maybe that's like 78-ish or something like that, playing for like a 6-7% bounce or something. And if we got that, we'd move that stop up, and we'd probably play for a gap fill towards that 80 level.
This is something, in trader parlance, if you're short something and then it gets down to your level, but now your opinion of it's changed and you think you can actually play from the long side, it's something we call buy the double. In other words, you buy to cover your short position, then you buy again to establish a long position. By the way, it works on the other side as well. When you're long something and then you sell the double. In other words, you sell out of your long position, then you initiate a short position. I think that's what crude oil is allowing you to do here, covering that short position that you had talked about, again, a month or so ago, and actually getting long. And it makes sense. And, if you go back and look since beginning of the year, February-ish, that's been the right thing to do. These sell-offs have been bought. These moves higher have been sold, and you're right back to where you start most of the time, which is around 78, give or take.
Yeah, so I just want to pull this out, Guy, to a multi-year chart, and we put a couple lines on it. One of the things I would just say, though, 73 and a quarter, if that's the buy point, I kind of want to keep the stop to the downside really tight here. You see that it kind of got just below that mini uptrend that's been in place since late last year. And, it's flirting with that level. It's still in a downtrend. You know what I mean? Like, so my point is like, oftentimes, especially with futures, you can have really tight stops and you keep probing a level. And sometimes you take little losses, to kind of prep for that bigger sort of move. So to me, I think this is, it's not a pound the table here. I like you buying the double, but let's see if it can hold. Let's see if it can get some momentum. And the other thing is, I just want to say this, you and I are not hoping for some dialing up of geopolitical risk in the Middle East like that.
No, it's not my no. And
we know, I know. I just want to make that.
Yeah, and if anybody's watching that's new, we just look at things through the lens of what it affects in terms of commodities and futures and equities and those types of things. As human beings, obviously we don't want those things to happen, but we have to try to sort of handicap things, and that's obviously out there. So that's and if you need to take these things into consideration, you can't sort of turn a blind eye to what's going on in the world.
All right, let's look at gold. This is one we've been talking about a lot, the futures here. I look at this 1-year chart, Guy, and we've been talking about that consolidation we had after that huge move. We made a new high. Okay, we checked back to that uptrend. And again, it's not the most brilliant uptrend, but there's a couple points that we can connect there. It checked back to that, and it made a new high again. So now we're back, that uptrend. Talk to me about what you're thinking about as far as levels here, because I know that you've been a repeat buyer of the gold futures on pullbacks like this, and it just seems to be getting more constructive, I guess, the look of the chart here.
Yeah, well, again, what we saw yesterday, at least in the beginning of the for the most of yesterday, was just forced liquidation, I would imagine, margin calls. And when you get those margin calls, whatever you're long or whatever you own, in a lot of ways you're forced to sell. Whether or not you have a view, doesn't really matter what your view is. If you're tasked with fulfilling a margin call, you got to sell things. And I think gold sort of fell under gold was sort of the victim of that, whether justified or not. But I think when people sort of examine what's going on in the world and the things that we talk about every day, all roads lead to gold. Everything we're talking about, this yen carry trade unwind, lower rates here in the United States, all those different things the geopolitical risk, the fact that central banks continue to buy gold, it just lines up. And, I think this is, if you've been a gold bull for the years, the environment that we find ourselves in is, I think, the exact environment that you want for gold to continue to go higher. And if it breaks down and if we, trade down to that moving average, I'll be the first to say, like, I didn't see that coming, but gold is in play here. And I think the more you read about what's happening, the more you sort of come to the realization that gold's going to go higher.
Yeah. So if I'm looking at the levels in the futures, I want to go back to July 25th, not that long ago here. It's 2350-ish, guy. And that might be, I know that feels like a tight stop, but I feel like if it goes through there, it's going back to that support level of 2300. Okay. So that's just, 50 handles, if you want to call it that. And who knows if it kind of stops there. You just mentioned the 200-day moving average. That's just below 2200, right? So the last thing you want to do is get caught up in a situation where you have to average down, right? You want to probe, a level to the upside. You'd be targeting, something in that sort of prior high. What is that, 2485 or something like that? And you get through there. I know your take is then you want to buy more, right? When you make a new high. So, and then you would keep moving that stop up a little bit. So I like the idea of playing with a short term, like a tight stop there. The 100-day moving average is like 2537. Maybe that's where you'd put that stop to the downside, guy.
And let's take a look at copper because, one of the most economically sensitive commodities. As much as gold is labeled a commodity, it's commodity in name only. Copper actually is an end-use commodity. And if you saw what we saw earlier in this year, where there was obviously a huge run into the copper world for a myriad of different reasons, a lot of supply-demand things going on, it's given the entire move back. And here we are. We should theoretically be at support in copper. Now it really just comes down to the supply-demand imbalance is going to sort of take hold again at these levels. But we wanted to show you copper because, again, this is illustrative of, it's funny, Dan, if you were to overlay a yield chart and overlay a copper chart, they're going to look very similar in terms of that spike we saw in yields and the subsequent cascading lower. And it actually, if you think about it, makes sense.
Well, I think this is the point that you've kind of made on numerous occasions. This sell-off in copper, the sell-off in crude, it is speaking to something. Now, there's always supply-demand dynamics, but oftentimes they could be related to just growth, and it could be related to China and a whole host of other things, and trade wars and tariffs and, all that sort of stuff, right? And there's stuff going on as it relates to Russia and Ukraine, if you were looked at nat gas and everything like that. So again, we haven't looked at a copper in a while. I think it's interesting at a level. It's through that 200-day, whether that is a good support level, that horizontal line or not, who knows? Guy, before we get out of here, let's look at the Mag 7 here really quickly. Okay, so we have to start with Apple. A lot of news there. We hit the Buffett thing yesterday. There's some bad reviews of Apple Intelligence from a guy who I think is, kind of the axe in the name. There's Google antitrust ruling from the FTC puts in maybe some question the $20 billion annually that Apple gets from Google, right, for this, primary search. They are the, the dedicated search engine on all iOS devices. And, it's interesting. This morning, it was down. Maybe we can look at a 3-day chart, down 3.5% after yesterday's move. It's kind of made a bunch of that back, but it was interesting that it gapped lower. And it just speaks to the volatility we're seeing just in the broad market, right? So 2% higher today after like a 3%. And we talked about this late last week with Carter. This sort of volatility or the widening of volatility bands, whether it be in the indices or single names, is not, like, in our opinion, it doesn't really speak to a bottoming process despite what we're seeing today. So thoughts on, like, a name like Apple versus an NVIDIA that's up 6.5% right now?
Well, so there's a lot to unravel there real quick. When Warren Buffett buys things, the network breaks with breaking news, Warren Buffett, and it's typically around the filing time when those things are announced. And the knee-jerk reaction 90% of the time is to send stocks higher. Warren Buffett's in, oh my God, let's get in as well. So, and it makes sense. But, it's interesting when he does the opposite and when he sells things, people have a much different reaction because obviously it flies in the face of their belief system. Like, how can that possibly be? Well, he made a pretty prescient sale, I would say, in Bank of America, and he's obviously pared down pretty significantly is holding an Apple. Now, The optimist will say it's just sort of he's just managing his portfolio management. Yeah, obviously that's true. Or he sees something else. By the way, it's not just Apple in a vacuum. It's the amount of cash he has on hand, the amount of treasuries he's been buying. He obviously sees something. And as much as people want to say, Apple is not really that consumer sensitive, if things do turn lower, Apple is not going to be insulated from a downturn. Number one. Number two, we got back to levels yesterday that we traded right back down. We're trading at in June 10th around the developers conference. That actually made sense. And your point all along has been, this is no great, it's probably not going to be any great shakes the first iteration, and the market's probably getting ahead of itself. So you throw all those things in the mix, and the move actually makes some sense to me, Dan.
Yeah, no doubt. Just a quick one here. So, you have, NVIDIA powering ahead. You have Microsoft up 2.25%. You have Google basically flat on the day. We know why. Amazon's up a little less than 2%. Meta's up 5%. And Tesla is up 1.5%. So again, some of the names underperforming the NASDAQ and the S&P. NVIDIA, they just can't quit it, guy, and they come back.
Well, they can't quit it. What did it trade down to yesterday? $90, I think. Is that right? Did it get that low? I don't know.
Maybe low 90s or something.
So we filled that gap on the downside. We talked about it yesterday. The bounce actually makes sense. You're still significantly lower than that June 20th high.
Yeah.
I don't think. All that's changed is, a couple days of price action. But, it's one of those things, like if yesterday's flush didn't happen and you saw NVIDIA at 107, you'd be like, shit, that hasn't traded particularly well since June 20th. So it's all in terms of how you get there. Like I'll say it again. We filled the gap. I don't think it's over. And if I'm wrong, I'll be I'm not shy. But if things happen the way I think it's going to happen, and this is just a short-term bounce over the next couple of days, the selling will start to accelerate again. And by the way, we had a question about the yen carry trade. We'll put it in the show notes. I think we can do that. A lot of it's been explained over and over again. But one of the biggest beneficiaries of that, as people put money, borrowed money, able to borrow money cheap and put it to work, are names like NVIDIA.
Yeah. So
it stands to reason that as this unwind continues, and JP Morgan, by the way, to your earlier point, I think put out a note that we're probably only about 50% through this unwind.
Yeah.
And Elizabeth yesterday had a tweet talking about how if you look at inflation adjusted yields in the United States and Japan, fair price for the yen's about 134. I don't think it's over.
Yeah. Really quickly back to that NVIDIA chart. We took a lot of heat, definitely on fast money. I think both of us were in agreement that those late May gaps, and there were two of them, were going to get filled. The lower one at 95, and it happened sort of quickly. And I'm in your camp. Today's 6% bounce, if Jacob wants to move that chart over just a little bit, it kind of looks like a blip. You know what I mean? Given the volatility that we've seen in the last couple of days. So, just because it's up 6%, yeah, maybe there's a little more to the upside. I want to make one last point on this whole sort of Gen AI trade tonight after the close. Super Micro, and maybe Jacob could pull up SMCI. This was just going absolute batshit. You remember this one late last year? And look at how it's made a series of lower highs. It just broke down from that, that consolidation. They report after the close tonight. They make servers that go into data centers, right? That power a lot of the training that that these large language models need. Okay, what goes into the servers? Well, H100s made by NVIDIA, right? And who else makes those servers that go? Dell. Maybe they can put up a Dell chart right here, okay? And, Micron, this was a story, MU, we'll get there in a second. Oh, well, you know what? These servers need a lot of memory now, guy, and that's what Micron makes, right? So look at Dell, filled in that huge gap from last year when that got on the kind of Gen AI trade, when people figured out, like, this is another way to play this. Now go to Micron on the memory front, right? And, the list kind of goes on and on. AMD, every time Lisa Su opens her mouth talking about TAM, right? And the products, these great products that they're going to have, the stock rallies and then it sells off and it makes new lows. So maybe we can pull up AMD for a second. So, as far as I'm concerned, some of the air is coming out of the trade of the other inputs to it, right? The last man standing, for all intents and purposes, is NVIDIA. And we're going to get a good read on that when they report on August 28th. The last thing I just want to mention, maybe they can pull up Amazon here really quickly. Okay. Amazon had that huge gap late last week after earnings. People did not like, despite the AWS growth that they had, which was nearly double of where it bottomed out a few quarters ago, guy. Like, this is one of the biggest beneficiaries, supposedly AWS and all the models that they're putting on there, and people coming or companies going there for the compute. So to me, this trade is not over to the downside because it got overly exuberant to the upside.
467 ETFs contain NVIDIA as one of their top 15 holdings. And, I only mention that because passive investing, that's why, talk about last man standing. In the world of passive investing, money flows into NVIDIA whether you realize it or not. And there's been some interesting work done on passive investing and the potential pitfalls. And listen, it's great on the way up. It's not great on the way down. And if we're ever to sort of become active, my view on this. So it all sort of makes sense, Dan.
Apple is the best example of that.
Yeah,
right.
We've said that for years. Yeah,
because you mentioned, that's what you just said, the 416 ETFs.
Yeah.
Okay, so Warren Buffett was an active seller over the last few months. Look at what it did to that stock. It massively underperformed the mega cap techs, you know what I mean? And so he still owns half the position. But the other point is that if you looked at the largest shareholders now, it's Vanguard, it's State Street, and I think there's one other, these are the three largest, ETF or they are the three most active or largest ETF holders. They own $3 billion together. Okay. So Buffett owned $1 billion. If there's ever a need, to go active on some of that. And, good luck. I just want to make one last point here. So our friend Doug Cass just sent this out. It's not just Apple that Buffett believes is overvalued and is aggressively dumping. The billionaire clearly believes the entire market was expensive, and Berkshire bought back only 345 million of its own shares during the quarter, the lowest amount since 2018. And that's really interesting. And the other point, we got to get Doug on sooner or later to talk about, do you remember in 2013, Warren Buffett at their annual meeting chose Doug to kind of pick apart some of the bear case? And I'd love to hear more about that. I know he and I have talked about it. I've forgotten a lot of that story. That would be certainly a fun.
We'll definitely have Doug on. And, we bring up Warren Buffett for obvious reasons, and that Buffett indicator that Doug had been talking about and we've talked about on the show, that was flashing red, as I said last night. That was flashing red for the majority of this year, and the market just sort of whistled past it. But it didn't mean it wasn't there. And I think, again, when you see what he has done or what Berkshire Hathaway has done with their portfolio, you can dismiss it. You can discount it. You could say he's wrong this time. He's lost something off his fastball. But the reality is everybody loves him when he's buying things. It's interesting how people dismiss him when he's selling things.
No doubt. All right, Guy, we covered a lot of ground. We hit the minis, the S&P minis. We hit yields. We hit gold. We hit crude. We talked about the Mag 7, a dead cat bounce or not. I think you'll agree with me. Keep an eye on NVIDIA if it could hold these gains, if the rest of the Mag 7 could hold these gains, if JP Morgan, which is bouncing 3.5%, can hold these gains. I also want to keep an eye on Lilly. They report later on the week, and it'll be interesting to see what they have to say. So again, we continue to be focused on these mega cap stories.
Put up real quick Market Matrix. We won't explain to you what it is, but if you have not subscribed, take a look. You should, because it's really cool. I think it's now week 14. Maybe I'm off by a week, but we've enjoyed it a great deal. So we will be back tomorrow. I believe EYT will be joining us on the Market Call.
Yeah, no doubt. All right, Guy, I'll see you on Fast Money tonight at 5 p.m. And then we're going to do Market Call all over again tomorrow, 1 o'clock. All right, thanks everyone for being here.